Mesdames et messieurs, bonsoir. Mon nom est François Boutin-Dufresne. Je suis ravi de vous recevoir ici à la Maison du développement durable, qui est le lieu où se trouvent mes entreprises, Sustainable Market Strategies, Nordis Capital. Je suis accompagné de mon associé, Lenka Martinec. Tous les deux, nous sommes parmi les fondateurs de l'Observatoire des Erreurs, qui est une organisation non lucrative qui est vouée à l'étude de l'histoire de l'économie et de la finance. Et nous sommes ravis de vous avoir avec nous ce soir pour le lancement de cette organisation-là. Pour l'occasion, nous avons la chance d'avoir avec nous le fondateur, l'idéateur de la Library of Mistakes d'Edinburgh, M. Russell Napier, qui est ici avec nous ce soir et qui sera notre conférencier demain. So with these words in French, I'm going to turn to English so that we have a common ground of understanding. It is a pleasure for us to have you all here tonight. We'd like to take this opportunity to thank our founding sponsors for this Observatoire des Erreurs. At first, the folks at BCI Research, who were kind enough to give us a grant to start the organization, and also the folks at InnoCap, two leading financial organizations here in Montreal. One that has less history than the others, but the two of them, I guess, will actually survive through time. So we're both happy to have them, very happy to have them with us here today. Just to give you a small idea of what is the Observatoire des Erreurs, well, these are our board members here that most of them are here tonight. Some of them are not able to be here tonight, but are also very glad that we're able to launch this and use this opportunity to discuss with Russell. So our ambition here in Montreal is to launch this organization, gather some support from the local community of people that are interested in economics and finance and history and policy. And we want this to be the most inclusive possible, so from people from all colors, all sorts of backgrounds, not just economics and finance. We want people from political science, philosophy, arts. We want people that are interested in what happened in the past and what could happen to us in the future. And we all want to be students of this history, and that's the purpose of this organization. My colleague Carl will tell us a bit more how we envisage the future. Our vision basically is to launch this organization virtually over the next couple of months. And once we have enough support, financial support, but also some followings on LinkedIn and our other channels, so please start to follow us on our different channels. We plan to launch a physical place where we'll gather books and become truly a library, which we'll be using to hold events, but also debate history and how it applies to today's economic and financial environment. With this, thank you again for being here, and I'll introduce Professor Russell Napier, who I've had the chance to meet a couple of years ago while I was visiting Edinburgh, and he was an excellent speaker at a big event that I attended. And he invited us at that time to visit the, I guess, Library of Mistakes 1.0 in Edinburgh, which felt a bit more like a glorified book club, but yet again, a very interesting glorified book club where everybody in, I guess, the Edinburgh financial and economic community would gather to discuss and debate historical ideas and how it applied to the current environment. So Russell is a very well-known investment strategist. He's the author of the Solid Ground Investment Newsletter for institutional investors. He's been active in the investment industry for most of the past 35 years. He's also the author of the Bears Lessons from Wall Street, 4 Great Bottoms, a cult classic apparently. And also Russell is, I guess, a professor at Edinburgh Business School. And most importantly, probably the best title anyone ever had in the whole history is Keeper of the Library of Mistakes of Edinburgh. So with this, I'll invite my colleague Lenka and Russell to come on stage and I guess instruct us about the reasons why that motivated Russell to launch this in Edinburgh and how he sees the role of Library of Mistakes and how it can play in today's environment. Thanks.
Before we get into the first part of our presentation today, we're going to do a little bit of a Q&A to understand who is Russell Napier and how did this get going, this library that is now actually an institution in many different cities around the world. Then Russell is going to do a presentation for us, the 12 lessons for the future that are taken from economic history. And then finally, my colleague, or ex-BCA colleague, Gary Evans, is going to open it up to a Q&A with Russell on what we can learn from those lessons and anything that you might want to discuss. So, let's get to it. François introduced you just a few minutes ago as about your work with your financial letter, these financial books that you have written as a professor of financial economics. But my understanding is your background is actually not in finance. You're a lawyer by training. How did you end up, of all things, getting into macro?
First of all, I have to begin by saying, as a professor, I've only ever failed one exam. Unfortunately, it was in the French language. So apologies, even if I tried, I'm afraid it would have to be in English. But my original degree was in, or degrees, because I've got 3 of them, are all in law. But I was offered a job in finance, so then I had to learn about finance. When you do that, and I'm sure many people here have been through that, they hand you books on economics. And they're theoretical books on economics. And frankly, I didn't learn very much from those books. And the books I had here, and then what I was watching on my screen every day, didn't really seem to add up. Also, I had a previous career as a butcher, because my father was a butcher. And I didn't see much in the economic textbooks that told me what was happening in the butcher shop either. They didn't seem to be connected. But when I started reading financial history, my learning curve tipped up. That was 36 years ago, and every time I read a book on financial history, my learning curve is steepening, or is still steep, whereas I find with the economics textbooks it was rolling over. So it was kind of self-preservation. I mean, it's a dog-eat-dog world in finance and investment, and you have to learn very quickly, and I thought that was the way to do it. And just one other thing, from the very earliest days, I never believed there was such a thing as a rational economic man. I just couldn't conceive of why anybody had invented a rational economic man. And I've been guided my entire career. I've never met one. And if I ever do meet one, I'm leaving the room quite quickly. So it seems to me there had to be a better explanation of what was actually going on than this cornerstone. I have 3 problems with the rational economic man. We're not all rational. We're not all driven by economic motivations, and we're not all men. But apart from that, it seems to me it's a fairly accurate description of what's going on in economics. So in a nutshell, that's why I turned to economic history, to better understand all these things.
Thank you. Yeah, I can certainly attest to some of those things that you mentioned about not being rational and not being men. The next question that I want to ask you then is, so you made these realizations quite early in your career that economic history or economic textbooks were not really doing the job, and there was more in actual real history and real life than what you can learn from the theory. I think there's probably some people in this room that share that point of view for sure. But how did that, what was the thing that said, you know what, I've read all these books, I've all got this information, but what was the thing that said, I need to set up the library of all things?
Well, we didn't begin with a library, so we began with a course in economic history, which was launched in 2004. So my problem is that I want to do things and then they don't exist, so I have to build them. So that began with the course. I said I'd love to take a course in financial history aimed at investors to teach them something, and there are thousands of courses in finance, so I'll just find it and take it, and it didn't exist. What's really embarrassing, it still doesn't exist, we're the only one. Now that's not completely true. So I then had to go and devise a course in financial history so I could take it. And then that started in 2004. By 2014, we've got lots of students, they're all coming out, they're saying, where can we read these books in financial history? Because they've been removed from the university libraries. And it's true. If I pick a book from my library, they're all second-hand to keep the price down. It will say, in the front page will be a big stamp saying ex-university library. Because finance and economics is taught by people who believe in the rational economic man, and they believe that all available information is in the price. And the definition of all available information is history. So these people went to the university library and they took all the books out. So the next step, having launched the course, is to launch a library. What I didn't really think about is other people in the world would want them, and will no doubt get on to that. And other people in the world are saying we need that as well. So it was based upon a realization that you can go to university, you can have a doctorate in finance and never have read financial history. You can have a doctor in economics, never have read economic history. So we need a venue where that can happen. And it's not just reading the books, because we have lots of lectures there as well. So I think the library was an essential part of this. And crucially, it builds a community. It builds a community of like-minded people who come to the library, who come to the events. So a physical space may be going out of fashion, but I think they're coming back.
So actually, I have two questions that you just touched on. One of them is around the community, so that you mentioned. And so one of the things that when we were discussing building our project, we thought of many times. Montreal has a fantastic CFA society. We have a very thriving association called the Financières Montréal. You talked about the fact that the people that came to you that were interested in these books were students. So you can see the population in the room today. Our goal is to really make sure that we make financial and economic history accessible to the non-CFA types. What is your advice, or how do we go about doing that?
Well, first of all, those people have a lot to give to economics. So I've just attended a conference called the Humanities in Economics. And I was the only person there from the sort of economics finance background, because most people from that background don't want to talk to English literature people. And at one stage in the conversation, one of the guys, I think he was an expert on Dostoevsky, he said, well, look, actually, I don't think we have anything to teach economics. And I said, you must be nuts. Do you know that they believe in the rational economic man? Dostoevsky knows a lot more about human beings. So if you come from an English literature background, a philosophy background, a sociology background, a politics background, these are exactly the skills that we need to get back into economics, finance, investment. And I think we can all see that they're coming back. You know, I think that there's nobody in this room who doesn't know that politics is quite important for the US stock market. Okay, how many people in Wall Street have got a degree in politics? So if there's anybody here who's studying these other degrees, I think you're desperately needed in the finance business or the investment business. We need people who can think differently, who can understand this. I think financial history is a shortcut to cover sociology, politics, and all those things. But we need to understand human beings better, and that will make a better economics.
And so in your community in Edinburgh, do you have a lot of non-financial types that visit the library? Tell us about something like, what is the typical person who shows up at the library these days in their events?
So Edinburgh is a bit like Montreal. It has a large neighbour not far away in finance, and it's sort of, it is to the north and slightly different. So we get a lot of the people from the financial community, of course we do. The second biggest group would be people who are having to make decisions about their own investments. That the time has passed when you used to hand over your money to a life fund or a pension fund. People are having to make decisions about which mutual funds they own, so that's another branch. And then we've got all these young people who turn up, and some of them are at school, and I'm never really sure how they hear about us, but they turn up. And you know, we've been running for 10 years. It's really, I had one father who came to me about 6 months ago and said, my kids had no idea what they were going to do when they were at school. And both of them have careers in finance because they came to this library. So I don't know how that works. I don't know what we said that got them enthused and interested, but I hope it was that we convinced them there was more than mathematics. I think most people, if they think about economics, and even to get into a good economics school, you need good mathematics. And I think a lot of people are put off saying, that's not for me. A lot of women are put off because they think that's not for me. They watch it on television with guys in red braces screaming at each other on the training floor. And I think we convinced them that actually there was more to it than that. So that's who we're getting in. So more and more young people. I must say of all political persuasions as well. We have some, we encourage dissent, we encourage argument, intellectual argument, not shouting. And we need a space for that. And more and more in society we need a space for that. We provide that space.
So now talking about spaces, you guys, I think, there's a picture of the original library up here. Some of my colleagues have visited the original library, and they loved it. The dark wood, the deep leather chairs, they got really excited about it. And I came back and I sort of, I hadn't visited the library, but when I heard their comments, I was sort of like, well, okay, is this really appropriate for today? I think a lot of the books, well, you mentioned that a lot of the books you can only find in your library, But in an era of information almost overload, you can find a lot of economic history books online. What is the power of having the physical space as opposed to just having or complementing events?
I should say that we have a full catalogue of every one of those books online. You can access it here in this room. So one thing you could do, if you, let's say you were interested in inflation, you could search books on inflation, and then you can buy them. To your own home, if you have the wherewithal to do that, you can buy them. You might be able to find them online, and most of them are in copyright, so in copyright material is hard to find online. So even if you're not in the library, it's helpful. But the space, the physical space is important to get this community, to get people coming together, and to get people knowing they're not alone. And I think it's quite easy to believe perhaps sometimes that you're the only one who thinks slightly differently. And even if you're in a financial firm, you may be the one person who thinks that there's more to life than financial modelling and discounted cash flow. Well, if you come to Library Mistakes, you'll find a few other people who believe that. So it's encouraging. Tongue in cheek, I call us a small errorist cell. But you have to be very careful with spell check when you put errorist into your emails. Particularly when you have, I'm from Northern Ireland, so I have to be particularly careful.
Two last questions for you. As we build out the content and the events going forward for our Montreal Observatoire des Erreurs, can you give me the hottest or most popular event or book that you guys have put on?
Well, that's interesting. Well, just to show you that we have a broad range, I think one of the best ones we had attended was a Buddhist nun. She's a friend of mine, but the Tibetans, or the Bhutanese actually, as you probably know, tried to measure happiness, and it didn't really work very well. So that was a mistake. Maybe trying to measure it wasn't a mistake, but how you measured it may have been a mistake. So we had people hanging from the rafters to find out perhaps how you could measure happiness better. But we are very lucky. We've had two chancellors of the Exchequer, former, I should say, current chancellors won't speak at the Library Mistakes, but two former chancellors of the Exchequer, so that gets in. We just had the Irish central banker, we had the Norwegian central banker, and I think the best was that he is a Norwegian, but he was a central banker brought in to clean up Iceland. Fantastic. I mean, that was one of the best things we did. So it's not just about getting financial historians, it's about getting people who lived it. We just had the man who restructured Greece's debt for the banks. We can get policymakers who've done these things to come and talk to people and younger people and pass that on. And on the whole, they're very willing to do it. And they don't fit particularly well inside an economics faculty, but they fit very well for us. So I think the ones that sell really well are people who've done it in real life, rather than people like me who've just written about it.
I have a theory, by the way, that central bankers are amongst the funniest people, have the best humor in all professions. So, so what I'm hearing from you then, in terms of upcoming events or speakers, quirky people like Buddhist nuns or central bankers. That's great. Last question, if you'd like to answer it, do you want to tell us what your biggest mistake has been?
Yeah, I think we all have the same mistake. We don't listen enough. Seriously, if I could do everything again, it would be to take lessons on listening. And when I say that, people just look at me as if I'm insane, but we go through life and we're not listening properly. So, I could give you 50 others, obviously, from my career, but not listening.
I don't know if you did that on purpose, but that is the perfect segue into what we will all be doing next, which is listening to you. So thank you very much, and I think we're ready to go in terms of a formal presentation. So if you want to step, yeah.
That wasn't a deliberate segue, by the way. That was entirely accidental.
Thank you very much. So nobody is interested in financial history unless it can give us some useful things about the future, and that's why I'm interested in it. My main job is to advise financial institutions on their asset allocation. I've been doing that now for 31 years, but I've been in the business for quite a bit longer than that.
And nobody pays me to go into a room and talk about the great banking crisis of 1866. That's not what you get paid for. They pay you to have some insight into the future. And I can think of no other profession in which it would be considered radical to make the statement, knowing something about the way the world has worked can tell us something about the way the world will work. That doesn't seem to be radical if you're a physicist, but it seems to be radical if you're in business, finance, or economics. In fact, one of the reasons that I went this route was because of a quote by a famous financial analyst called James Grant of Grant's Interest Rate Observer, who once said that in the sciences, knowledge is cumulative, but in finance, it is merely cyclical. And if you're in the financial business, you can see that. But the question is, why? Why is it that we don't learn so much from the past? So my job here today is to talk about these 12 lessons, not just in context of why they're the important lessons for the way we live now, but also what they can tell us about the future. Okay. Seems easy. If you've never ever even studied or thought about economics or finance, you do know something. It's all about supply and demand, right? I mean, everybody knows that. Your grandmother probably knows that. But I've spent a long time talking to people who do this for a living, and I would say they spend 90% of their time talking about demand because it's interesting. You know, how many iPhones will be sold next year is interesting. You know, how many buildings will be built here in Montreal next year is interesting. But the supply side is just not so interesting. So I always say that demand shoots for the stars and supply rises from the mud. And that used to be literally true. Of course, it's not so true now that we're building apps and AI. So when you're going to look at something, you need to look at both supply and demand. Now this particularly relates to China. China in my career and China going forward. China was the biggest supply side shock in the history of the world. Now you might argue that the opening up of the North American continent was bigger, and maybe over 100 years it was bigger, but not in the time frame we're talking about of the last 30 years for China. It happened much faster than anything that happened here with the arrival of the railroads. China did it all much more quickly, and the great surprise was the flood of supply. So I was there when this started because I was a fund manager in 1992 when the first Chinese stock was listed on the stock market that was available to foreigners. We all know how much the Chinese economy has grown since then. It has been unbelievable, and it was the most bullish person about the economy in 1992 wasn't bullish enough, and we thought everybody was being too bullish. So in 1992, there's a company called MSCI. It creates a stock market index for China to map how the stock market does from 1992. And you can look on that on your iPhone now, and you'll discover that from 1992 until 2025, the stock market has gone down, not up. We've had a biggest economic revolution in the history of the world, and the stock prices went down over a period of 30 years, nearly over 30 years. Why? Well, I was there when these companies came to market. I remember particularly one called China Southern Glass, which was going to make glass for buildings like this. Now, I think you've probably got some idea of just how many buildings like this have been built in China since 1992. And yet, until recently, the share price of the company didn't go up. How could that possibly happen? Well, various reasons, but fundamentally, China was able to produce glass as fast as it could demand it. And the returns didn't go up because of overproduction and overinvestment. And that really conditions most of what's happened in our lives in the last 30 years. And I won't go into that in detail about how China's ability to overproduce has changed inflation, changed global interest rates, changed investment patterns. That's the period we've lived through, but it's over. And that's why I bring this up as the most important lesson for tomorrow and next year and the year after. This is coming to an end because the world can't take it anymore. Because the world can't cope with it anymore, whether it's solar panels, EVs, medical devices, steel. The world can't cope with the sheer ability of China to produce ever more. And that's where tariffs are coming from. And tariffs are not just coming from the United States of America, they're coming from Europe. And it's an if, but if we should find ourselves in a Cold War with China, which was somewhat like our Cold War with the Soviet Union, we wouldn't be buying anything from China. And that would be the biggest supply shock in the history of the world, well, at least since 1914 or 1939. And that is now a possibility, in my opinion, a probability. So having lived in this world of overinvestment by China, oversupply, overabundance, we would very quickly find ourselves with a huge supply shock. So you need to consider how the world works if we don't deal with China. And you need to look at what you want to invest in a world where we don't deal with China. You want to think about inflation and interest rates in a world where there are two blocks in the world, as there used to be up until the fall of the Berlin Wall. That is not what's happening. Everybody's still focused upon that demand thing. What is the demand for AI? How big will AI get? Tell me more about AI. But behind that, there's a huge global situation with supply. This might surprise you, it surprises many people, but there is no relationship between the growth of GDP and the return you'll get from equities. I just mentioned that remarkable situation in China, where you've got no return despite the remarkable growth in the economy. There are many other examples. You probably know that Japan's stock market peaked in 1990 and it was well over 25 years until it got back there. The American stock market peaked in 1929, it was 1958 before it got back above its high. So there's more to life than economic growth. And the reason that is particularly true for the stock market is the stock market is always trying to discount the future. And there's a huge range in its valuations. And it's value that counts. So a smarter man than me once said, price is what you pay, value is what you get. That's Mr. Warren Buffett. And if you pay too much, it really doesn't matter that the economy grows and things work out. Now you might say, well, why is that relevant for today and tomorrow and next year? Because the US stock market, for only the second time in its history, has reached what's called a cyclically adjusted PE valuation above 40. Now that cyclically adjusted PE, we don't need to go into the details of it. It was popularized by Nobel Prize winner Robert Shiller. But it's a measure for valuation for US equities that goes back to 1881. And only twice in history has it been, only once in history has it been above the current level it is today. So history strongly suggests that even if the US economy grows, we are likely to see poor returns from the stock market because it's so grossly overvalued. It was overvalued slightly more in the year 2000, and clearly from 2000 to 2009, you had dire returns from US equities. The period from 1900 to 1921 saw a decline in equity valuations. A period when America went from being an emerging market to the new American century, and you still didn't make money. You didn't make any capital returns in the equity market. Why? Well, because it was mainly railroads. So you invested in the right country, you invested at the right time, but you invested in the wrong industry, because that is primarily what was listed on the stock market. So there are other reasons, and there are many reasons why equities don't necessarily link to returns. I was in Asia, working in Asia in 1995. UK pension funds had invested more money in Asian equities ex-Japan than they had in America. Astounding. And Netscape came to market. There'll be people in this room who are not old enough to remember Netscape, but it was the trailblazing internet stock, the dot-com stock, and we all laughed at what these crazy Americans were doing with these pushing up the price of such a ridiculous share. And what happened? Well, Asia had a crisis, but Asia has grown faster than America since 1995, certainly since 1998. But the American stock market has far surpassed the returns of the Asian stock markets because they had the right companies. It turned out that that type of company, that digital company, was going to be the company that would dominate the world, and it turned out they were nearly all American, And it didn't matter that Asia had higher economic growth because the Americans had these corporations. So stop listening to people talking about GDP growth. It isn't worth the effort. One of the things I do, I've got various things I do. I run a website where we try to sell economic advice. Anybody can be on that trying to sell their research. We can't sell economists anymore. Nobody wants to buy it. I'll just leave it there. So I think this is the smartest man in investment. Sadly, no longer with us. Obviously, Warren Buffett's sidekick. Also, by the way, a lawyer. I should say now I rest my case. Never ever think about anything when you should be thinking about incentives. I see investment advice written every day about corporations, about cash flow, about reinvestment, and virtually nothing about the incentives of the people who run that. Now, we live in a world where virtually everything you invest in is run by an agent and not by a principal. I think we all know from personal experience that agents and principals see the world rather differently. But if you're going to give your money to an agent, whether he's running a corporation or running a mutual fund, I think you want to be absolutely sure that you know what his or her incentives are and make sure that you agree with those incentives and are aligned with the incentives. So when you're investing today, whenever you leave a room, whenever you speak to anybody, ask yourself, what are the incentives of that person? In other words, it's more than just about the spreadsheet. It's more than just about a discounted cash flow. If you think investment is really a game of maths, give your money to somebody who's got a completely different incentive to you and build a spreadsheet around that. So governments, this used to be controversial when I said it, but the myth grew up that a government was a referee, particularly for those who went to business school. There were two teams on the pitch. There was supply and demand, and the government stood to arbitrate in the middle to enforce the rules. And from all of that, you derived what the price would be, and there's nothing in financial history that says that's true. The idea that the government stands impartial as a referee in this battle between supply and demand is just false. And they can take either side of that, depending upon their political objectives. I think the obvious Thatcher-Reagan revolution was a desire to create more supply in an era of high inflation. And I think we shifted right along the continuum now to somewhere else. But through that, governments have been much more active. And of course, we see it today. We see it obviously in the form of Donald Trump. But we're seeing it more and more across the world. Politicians don't like what markets have delivered, and politicians will change it. Now, that's what I said about having people from other disciplines involved in finance, economics, and investment, because there are other people who understand that. They may be sociologists, but they understand it. They maybe understand the direction of it, but you're certainly not going to understand it if you live in this world where the government is an impartial referee and you are playing the game and they're not getting involved. So the next time you think you're winning an investment, remember the government can change it tomorrow morning. For those of us in the room who've been involved in this business, I would say since 2009, all we've been forecasting is the reaction of the government. We've not been forecasting the action of the market or the action of the economy, but all the money that's been made has really been forecasting the reaction of the government. So maybe we've been in a political economy for much, much longer than we ever wanted to be, but if you ignore the political economy, you're going to be in deep trouble. I would like to be able to forecast with a great degree of accuracy where the stock market is going. There is one way we can do that. Now, before we get too excited, not tomorrow, next month, or even next year, but over the very long term, in a free society, corporate profits mean revert as a percentage of GDP. If you want to forecast the future, find a series that mean reverts. It's a very simple assertion. Find a series that mean reverts. Because if mean reverts, it can tell you something about the future. Perhaps not in a time frame that you're happy with, but at least something about the future. This is the most mean reverting series in economic history that we can find. And I'm not a mathematician, but we can run a thing called the Audi-Dickey-Fuller test on this. And it mean reverts, at least for America. Not necessarily for every other country. And if corporate profits to GDP are high, there are forces in society that eventually, and it is taking rather a long time, but eventually do something about that, whether it's through the government, whether it's through action by labour, whether it's through higher interest rates, whether it's through higher taxation. But in a free society, the corporate share of GDP does not remain high forever. And of course, the reason I flag it today is that certainly for the United States of America, it's at an exceptionally high level. So that would suggest over the longer term, corporate profits would mean revert, and that it wouldn't necessarily be a good time to buy the stock market. If you can find other wonderfully mean reverting series, please let me know, and we'll set up an investment management company together. Because sadly, there really aren't very many of them. So when you find them, I think it's worthwhile paying attention to them. But to stress again, the problem is it doesn't necessarily work in the time frame under which you're being paid and rewarded to manage other people's money. Any idea? Yeah, so monetary policy, it gets talked about all the time. It's on the paper today, because obviously the Federal Reserve is active today. And you will find lots of discussion about monetary policy. And you know what it won't actually mention? I guarantee there will be not a single mention on money. Now that's rather ironic when you consider they're discussing monetary policy, because what everybody will be talking about is the price of money, but not the quantity of money. Now we sit in a city which is famous for its analysis of the quantity of money. That's where BCA started. And it's important and it matters. You should think of interest rates the same as you think of the accelerator on an automobile, and the supply of money as the engine. It's the engine that matters. Of course, what you do with that pedal matters, but it doesn't always flow through easily. And here we sit today, still discussing the price of money, still discussing the accelerator, and still ignoring what's going on under the bonnet. What's going on under the bonnet, actually, is just moderate growth in American broad money. But in Europe, it's really very low. In Japan, it's virtually non-existent. If you were looking at monetary policy as the quantity of money, you would be a little bit concerned today, particularly outside of the United States of America, that things weren't going very well. So the next time somebody tells you that a central bank is doing something, ask them what the current level of money supply growth is, what this is going to achieve in terms of that, what are the consequences of that. And you'll find that many people don't even want to discuss it. Now, a very famous incident many years ago where Alan Greenspan was giving a speech, and Paul Volcker, another former Fed chairman, was in the audience. And Greenspan spoke for 1 hour and didn't mention money, which is really bizarre when you think that he's the man in charge of monetary policy. So as he left the stage, Volcker went up to him, because Volcker used to talk about money all the time, and said, "Alan, whatever happened to M1?" For those of you who don't know, M1 is a measure of the supply of money in the economy, a particular measure. He said, "Alan, whatever happened to M1?" And Greenspan said, "It used to be the name of a pretty good machine gun." So, just because they're supposed to be running monetary policy doesn't mean they are. So if you're trying to work out what's going on, yes, of course, look at interest rates, but also look at the supply of money. Now, I can talk about 90 minutes on this, but just very briefly, if I tell you there's going to be a bear market in the stock market, and you close your eyes, what you see is 2007, 2009, possibly 1929 to 1932. That's what you see. But that isn't how stock markets always come down. There were two periods, 1900, 1901 to 1920, 1966 to 1982, and that's not how you lost lots of money in the stock market. You lost lots of money in the stock market because inflation came along, interest rates went up, and slowly the valuation of equities was ground down. So you were paying too much at the start. Earnings were pretty good. Nominal earnings in particular were good. You would have expected to make a lot of money, but over the period, interest rates had to grind higher and higher to try to control inflation. And over those very long periods of 20 years and 16 years, even as your earnings were growing, you lost money. And there was no spectacular crash. There was no 2007 to 2009. There are other ways to lose money in equities. And when they're very expensive, and if they're going to mean revert, there are two ways they do that. Either earnings collapse, which happens very dramatically, like 2007, 2009, where there's a long, slow battle against inflation, which gradually grinds down those valuations. For what it's worth, I think that's the sort of bear market we're probably in today, when it comes, rather than the sort of spectacular 1929-32 crash. So don't think that absent a major calamity or a credit crisis, you can't lose money in equities, because there are other ways to do that. This is, I think we can be quite quick on this. Often I hear the word hyperinflation brought up, and we have a lot of debt in the system today, and people say there'll be hyperinflation, and that is a word used a lot. It's not going to be hyperinflation. You don't need to print a lot of money when you can steal people's savings. No country with lots of private sector savings has ever gone to hyperinflation. It's only after you've exhausted everybody's savings that you go to hyperinflation. One thinks of Germany in the aftermath of World War I, having borrowed huge amounts of money from its people and defaulted on those loans, having wiped out the savings, could not go to its people to borrow money. The government could not borrow money from its people, so it printed it. Similarly in Zimbabwe, similarly in the former Yugoslavia. It's only after you've exhausted the private sector savings that you're desperate enough to go to the printing press. So Canada will, so the good news is Canada will not have hyperinflation. The bad news is that's because it will come for your savings first. And that is true of every developed world nation. They're all over indebted. It's not an American phenomenon. I can show you many countries with much worse debt numbers than Canada, or than the United States of America, particularly France, by the way. So we're moving into a world where we have to inflate away those debts, and that is your savings. So we maybe get onto the Q&A as to how that can happen and how that can work. So good news is no hyperinflation, but for a saver, that's not necessarily good news. If you're a debtor, it might be quite good news. Yeah, so technology never ultimately beats inflation. I did this at the University of Oxford once, and there was a professor of physics in the room. It's always the professors of physics that cause the most problems. And he pointed to his digital watch and pointed out that he paid $650 for a digital watch in 1972, and the one he was currently wearing he got free in a packet of cornflakes. And he said, well, how can you possibly say that technology doesn't defeat inflation? Look, this is what happened to my digital watch. The problem was that in that exact same period, the consumer price index was up 800%. So it is true that inflation had, or technological breakthrough had managed to deflate some of the prices in the basket, but the basket itself was up 800%. And just coincidentally, the growth in broad money over the period was 800%. So money will beat technology in terms of driving where we are in terms of inflation. This was contentious until 2022, but we just had a big burst of inflation, which followed a big burst of money supply. We also had at that time massive breakthroughs in technology, really accelerating with the arrival of Zoom during COVID, and yet we had inflation anyway. So we've had huge technological breakthroughs over 100 years, and prices have been going up solidly through that period. So every 30 years or so, monetary systems fail, and we live in a failing monetary system, and Gary, maybe we can talk about that today. And I sort of hinted that this is because the last 30 years has been dominated by China, and a link between the Chinese exchange rate and the dollar, and it's breaking down. And now I'll say something which I shouldn't say. Everything you've learned for the last 30 years isn't very relevant. I shouldn't say that because I'm selling my prowess as someone who's been around for 30 years. But sometimes when these things break down, you need a whole new set of rules, a whole new set of understanding. And of course, I'm repulsed by saying, well, at least I'm a financial historian, so I've studied some other periods in history with different monetary standards, different relations, different outcomes, and that's where we stand. I find it bizarre that we can all read the newspapers, see the massive structural changes that we are all living under, and imagine that the monetary system isn't going to change, that somehow it remains constant and steady, even though geopolitics changes, internal politics changes, populism or whatever, and yet somehow this will stay the same. It's highly, highly unlikely to stay the same. You can have a whole career and not live with one of these. I mean, my career started in 1989. If I'd only retired 2 years ago, I'd never have to live with one of these. But for everybody in this room, you're going to have to cope with it and understand it, and that's going to be a lot more difficult than using all the skills that you've known for the last 30 years. This is very, very important. I've been talking to and advising investment managers for 31 years. I've never used a decimal point yet. It's difficult enough to get the direction right, never mind the magnitude. Now you may say I'm cheating, because why would anybody pay for my advice if I'm not prepared to be that precise, to forecast the direction and the magnitude? Well, the problem with a decimal point is that it fools you. I often stand up with other people who make forecasts with decimal points. And of course, everybody believes the guy with the decimal point because he's precise or she's precise. They clearly have a much better understanding of the future than I do. And you know what? Sometimes they put 2 digits to the right of the digital point, and then they're really smart. Well, the future isn't that easy. The future is really quite difficult. And to begin to wield decimal points in that it's a marketing gimmick. It's me trying to sell It's me trying to sell my services to you with full precision to convince you that I really know what I'm talking about. So there is only one thing more dangerous than someone using a decimal point is when you start using one yourself. Because now you've convinced yourself that you can forecast the future with a great degree of precision. So Lord Keynes, I own a brewery, and I made a beer once called Roughly Right, and it was a very, very good beer. And it comes from a quote from Lord Keynes, who, let's just say, was one of the smartest people of the 20th century. And he said, "It is better to be roughly right than precisely wrong." So let's all aim for roughly right, and let's not get too carried away with the decimal point and being precisely wrong. And finally, I stole this from Karl Marx. Karl Marx, brilliant sociologist, in my opinion, not a great economist. We might discuss that as well, Gary. But he did say that religion was the opiate of the people, but actually it's extrapolation. Straight line extrapolation is the opiate of the people. We, particularly in groups, when we sit down together, see the future in the context of the immediate past. It's called availability bias. And when I went to work in Hong Kong in 1995, I wrote in large letters in the sign above my desk, "No extrapolation allowed." And every single person in front of me came into that room, extrapolated from the last 3 to 4 months. That is just humans. That is who we are. We hate uncertainty. You can prove it. You can prove it over and over again. And to walk into a room and provide certainty, whether it's with a decimal point, whether it's with extrapolation, you will sell stuff. People will come to you. I think particularly of Mussolini. People voted for Mussolini because he made the trains run on time. He walked into a world of uncertainty and brought certainty, and human beings are suckers for that sort of thing, whether it's in finance or politics. So remember, beware of the person promising fake certainty, whether it's a decimal point or whether it's extrapolation. So in terms of, at this minute, 12 lessons from financial history for the way we live now, and those are I think, the most important 12 lessons. But Gary's going to ask me questions to show that there are many, many more. Thank you.
Well, I have a list of about 25 questions here, and Russell asked himself about 10, so you're not having any questions at all. Let me start with one about the library. Why is it the library of mistakes? Haven't we done a lot of good things? Neil Ferguson wrote a book saying a limited company in insurance and pensions, maybe even hedging derivatives. We've actually really improved humanity by financial innovation.
So here's a secret. The library of mistakes is full of successes. So why is it called the library of mistakes? Well, there were two options. It's called the library of mistakes, or I could have called it the Edinburgh Business and Financial History Library, but nobody would have turned up. So the concept of build it and they will come is stupid. So we're trying to make it interesting.
I thought you were focused on supply.
We're focused on supply and demand. We're focused on balancing both of them. But you know, the Edinburgh financial history might be who's going to turn up. So the idea is to make this interesting and exciting, and it's working. You know, it's working, and the name moves, so it's marketing.
Second question is, you made the point that not enough people learn from economic history, but the fact that we've got a turnout here like this, and the fact that the Nobel Prizes this year were awarded to people like Peter Hallett, who maybe you don't know, studied economics and McGill down the road, does that suggest that actually people have started to realise that economic and financial history is important?
Yes. I had lunch 2 weeks ago with Deirdre McCluskey, who's one of the best economists, philosophers, sociologists out there. And she pointed out, actually, it's the last 3 years. If you look at the Nobel laureates in economics, they're not actually Nobel laureates, as you know, but anyway, what we call Nobel laureates for economics, all
Prize for the
Sturgis Memorial Prize. Alfred Nobel never conceived of one for economics. But anyway, the last 3 have been granted to people who at least have 1 foot in the economic history camp, and that is tremendous. So the pendulum is beginning to swing. It's got nothing to do with lighting mistakes, obviously, but even economists they're having to change their mind, because the great financial crisis, the global financial crisis, they had to change their mind. But it was a long time ago, and it's taken a while. But I think, yes, it is swinging. It's fantastically good news.
So you very kindly mentioned BCA's interest in monetary policy. The other big thing that BCA has always been interested in, that you didn't mention, well, tangentially but not directly, was debt. And Martin Barnes, who we had a nice conversation with in your library in Edinburgh 3 weeks ago, invented the concept of the debt super cycle. And today we have a situation where US government debt to GDP is over 100%, Canadian household debt is at ridiculously high levels, Chinese corporate debt to GDP is very high. What lessons have you learned in the past when governments or the private sector or corporates have built up lots of debt?
Yeah, so in my day job, I also had a lot of debt. Maybe that's because in 1990, when I started in this business, I used to get BCA research. Maybe from an early age, I was asking different questions, partly because of BCA. I should say, by the way, the library exists in Edinburgh, Lausanne in Switzerland, Pune in India. There will be one in Singapore next year. There will be one in London, and hopefully, we're going to make rapid progress in Montreal. So it is happening, and I really should have put that in line of your last question. It's not happening because I run around the world telling people they need libraries and mistakes, because I'm kind of exhausted. People come to us and say, we need one. We need, this pendulum is swinging, and how are we going to educate ourselves? And then, so the quick word is that. Now back onto the issue of debt. There are 5 ways to deal with debt. So there is austerity, default, hyperinflation, very high real growth, or financial repression. Now, austerity is...
None of those sound very good.
None of those sound very good, but the other thing is that it's a politician who's making the decision, so it's even worse. Austerity, as you know, is rather unpopular with the voters, so I really don't think it's going to be austerity. Austerity means the government sort of stops borrowing money, cuts spending. It's probably not going to be that. Default, well, we discovered with Lehman Brothers that if you default on something, that's somebody else's asset, and it doesn't necessarily mean you move to a land flowing with milk and honey. You leave a great big hole in somebody's balance sheet. Hyperinflation we discussed, and it wipes out the middle class. And historically, that's been a rather bad thing for social stability, and is obviously associated with the rise of Hitler. So, on the whole, politicians tend to avoid that one. Then there's really high real growth. That is the dream. That's what we all want. We want this productivity revolution. We need it. And it's probably not within the gift of government, but that would be the dream. So we just leave that hanging there and hope it happens. And then you have financial repression, which is really what I was talking about here, which is when we force everybody in this room to own the government bonds of Canada, yielding, say, 3%, and inflation is 5%. And over a long enough period of time, we deal with the debt. Well, as you say, none of these are really very nice. But if you're a politician, the 5th one doesn't seem so bad, because it's only bad for savers. It's good for debtors. Economic growth can be all right. but savers lose a lot of money. I have talked about financial repression for many years. I once did it in an audience of old retired people, and the first question from the floor was a lady who said, "Tell me what financial repression is again." So I thought, well, I didn't do a very good job in explaining that. So I've now just decided to call it stealing money from old people slowly. And stealing money from old people slowly is the least politically negative way to do this. So in my opinion, we could talk for hours and hours and hours on debt. It's a huge subject. Martin's right about that. But if I try to sum it up very simply, I think we get that financial repression. So you'll be forced, or your pension funds, your life funds will be forced to own Canadian government bonds. Last Tuesday, the government of Canada announced that pension funds would be repatriating capital to invest in Canada. The British government announced that quite a long time ago. The Germans have got a thing called Made for Germany. All around the world, governments are mandating that capital comes back to fund what needs to be funded in their own country. And at some stage that will involve buying government bonds at the right price for politicians. It takes a long time. I should say that that is, Canada is one of the worst in the world for debt to GDP when you put public and private together. And you're talking about 15 to 20 years to sort that out under a financial repression.
So I'm going to ask one more question, because I'm sure people will have lots of questions in their audience. And I suspect this is a question that's probably on everyone's mind. And you specifically said today, and the part of this was recorded, you do want to talk about the present and the future, because you've got a newsletter to send. Fair enough. Nvidia hit a market cap of $5 trillion today. That's the equal of the real estate, materials, utilities, oil, energy sector in the US, all together, every company, one company.
Yeah.
Is this a classic bubble? Is it like 2000? How does it end?
So we've seen lots of bubbles, and we've seen lots of technology bubbles. Now I can promote somebody else's book, because there is a fantastic book on this written by a friend of mine called Sandy Nairn, Alistair Nairn, called Engines That Move Markets. So he's looked at all of them. And here's some of the things that they have in common that you can link to this one. So there's a massive capital expenditure, there's massive investment, and that's what's driving this. And the investment grows and grows and grows, and as long as the investment is growing, then the market tends to go up. And we kind of work on a hope that there will be a return on this invested capital, an economic return. But obviously there has to be a limit to that. So at some stage we stop investing, at some stage we stop buying all of this stuff, and then the whole thing falls apart. That still hasn't answered your question, because you want to know when we stop buying the stuff. So only two ways that can happen. One, the board of directors tells the chief executive to stop. This has never happened in human history, I don't think, ever. So it's possible, but it seems unlikely. Or the market forces it to stop. And the market forces it to stop by increasing the cost of capital. Now in the dot-com bubble, that was really very, very difficult, because all the capital was provided by equity. So it was a catch-22. Only when the equity market started to go down did you call an end on the availability of financial capital for investment. But this one actually has quite a lot of debt. Not all, but there's some debt in it. So I would say look at the debt markets. Look at the willingness of the debt markets to provide capital for the capex boom. And if you begin to see yields going up in the debt that's been issued, that is a sign that the market's beginning to call an end to that. Just to give you some idea of how this works, Amazon, which was the clear winner in the dot-com bubble, fell 90% from its peak in March 2000 to I think early 2003. But if you run a chart of Amazon from 1999, you don't even see it. 90% decline isn't even visible. So the lesson of Sandy's book, whether it's railroads or anything else, wait for the whole thing to fall apart and then try to pick winners. Which is not to say it's easy to pick winners, but when the capex comes off, littered amongst the debris, that's when you find your winners for the next cycle. So I'm happy to say that this cycle will be really quite similar to that, and that's a little indicator that you might look at to see when it comes to an end, which is when the cost of debt goes up for these investors in the capex. That's the sign that coming to an end. I don't think it's here yet.
So, questions from the audience. We've got a microphone as well.
Do you want to ask? Gary's taking a break from asking his questions. Does anybody want to take a stab?
Yes. Hi, Russell.
It's a lawyer asking questions.
Yes. And sorry for the French Canadian accent. It's great to have you here. You have a beautiful brain, so beautiful mind, I should say. So thank you so much for being here. I've been following you for a couple of years now. Question I have for you is, I think at one point on a podcast you said that the terminal value of foreign investment in China will eventually be zero. So what did you have in mind when you said that?
Yeah, you see that beautiful mind thing? Can you write that down and send it to my wife? She doesn't always agree on that. So that's a very simple thing on a Cold War, because I'm old enough to remember the last one. And then we've got a very practical example of that. I don't know if anybody in this room was unfortunate enough to have been investing in Russia on the invasion of the Ukraine, but many professional investment managers were, because there's actually a very successful bank there called Sberbank. It was very cheap and many investment managers held it. And Russia invaded the Ukraine. And if you held Sberbank then, well, you still hold it, because you can't get your money out. And if you have it in a portfolio, it's effectively valued at zero, because it's not fungible. You can't turn it into Canadian dollars. I mean, you can't give it back to your pensioners. So that's what I mean about China. Now that may be a very bearish outlook for where we end up with China. And it's got nothing to do with finance and economics, and it's to do with things that I'm really not qualified to talk about. But nobody in the financial world is qualified to talk about them, which is geopolitics. So we've got a rise of a new superpower. It is conceivable that that is peaceful with the old superpower, but I think that's the least likely scenario. And I would argue that these two superpowers are already fighting two proxy wars. China buys oil from Iran. Iran finances military activity in the Middle East, let's call it that. China buys Russian oil, which finances military activity in Ukraine. This is not dissimilar to the way the old Cold War worked. And at some stage there's a great schism. So this is like two great tectonic plates rubbing up against each other. And the great geologists of the world just don't know when those plates slip. I don't think any of us can know when those plates slip, but I think the most likely forecast is they slip. And the day when they slip, then the terminal value of your investment in China is zero. So that's it. It's nothing to do with money, it's nothing to do with finance, it's to do with geopolitics.
Maybe you go back to number 12.
This one?
Yeah,
This one?
And also your number 9.
I think it's over there. Where's it? This computer. It's over here. There we go.
I've read some places that we eventually with the advent of AI and robotics, we lower the prices. Lots of goods with much like with small factories where they get off. So it's really just comparing to what you're seeing now over there with your product.
Yeah, sure. So absolutely. I mean, if we do away with the need for humans entirely, then you would think the cost of production would come down. Or another very good example, I'm looking at the gentleman behind you, I'm told that AI is going to wipe out lots of lawyers. Does that mean legal services will get cheaper? The point is that this has been going on throughout history. Now, it may be that this is the fastest acceleration that this ever happened, but it's been going on for all of history. And yet prices go up. So there must be something else. And what the other thing is the quantity of money. So if we lived in a world where the natural price decline, the natural forces was for prices to decline, but the total amount of Canadian dollars was growing at 20% every year, the price of goods in aggregate wouldn't go down. So maybe something else that goes up, but maybe the price of a haircut that goes up, maybe the price of a plumber that goes up, and maybe rentals that go up. But as long as you're prepared to print enough money, history suggests that the deflationary impact of technology, which has been around for a very, very long time, will be offset by the printing of money. Now we go back to the debt question. If you live in a society with a huge amount of debt, and that's what Canada is, it's one of the worst in the world, the last thing you need is a collapse in prices. The last thing you need is a collapse in the ability of people to earn money and corporates to earn money, because then you get massive debt default. So there's a huge incentive for the government of Canada or any other country to make sure that that doesn't happen. Because it's like a Great Depression. The consequences are a Great Depression. So history suggests that regardless of technology is always pushing prices down, but despite that, in aggregate, prices always go up if you're prepared to print enough money. So that's the argument.
Thank you for coming, Russell. I have a question. Given your knowledge of history of financial market, what's your view on Bitcoin?
I was waiting for the Bitcoin question, so I get that a lot. So let's split the cryptos into three different bunches, which is central bank digital currencies, stablecoins, and Bitcoin, which is private sector crypto. So I think deal with CBDCs very quickly. I don't really think the central banks will push them too far because they risk the stability of the financial system. So I'll just park that. Stablecoins are really interesting because I think they have a great future. They are effectively money market funds linked to the blockchain. I think they can be used by corporate treasurers to transfer money. That gives you a nice big float in US treasuries. The Secretary of the Treasury is very keen on that. You and I will maybe use them for large-scale transactions if we're buying a home or something, perhaps. But we obviously won't hold money in them as a store of value because we'll have money market funds which pay interest. But the stablecoin can become quite big. That does get me, I'm going very quick here, that does get me to Bitcoin. Every year that I look at it, there's less and less for it to do. You know, if I go back 5 years and I was told what it was for, every year that goes on, there's one less thing that it's for. So Arthur, you might be a great fan, but when I ask people what it's for today, they say it's to avoid the government. That's what it's for. Well, that's a pale shadow of what it used to be for. It was going to be a means of transaction, a store of value, and a method of accounting. Turns out it's not any of those, which is a bit bizarre given that we're calling it a currency. But if it is genuinely a way to avoid the government, to avoid paying taxation, to avoid regulation, to avoid exchange controls, it isn't compatible with a stable society. So they'll ban it. Now, that's not where America is today. Obviously, the Genius Act is promoting a lot of things. But if that is genuinely what that is for now, then it will not be permitted to continue. So I think the future for Bitcoin, private sector crypto, is not great. The future for stablecoin is very good. By the way, I should mention the stablecoin. Scott Bessent thinks it will undermine China as well. He thinks that many people in the world who are unable to get their money out of their country will be able to get it into stablecoin. That's a capital outflow, and it will undermine China. Unfortunately for him, it undermined Argentina long before it undermined China. So these are actually weapons of war in some ways. So the stablecoin is a weapon of geopolitical war, and the Bitcoin is in that war between the private sector and the state. And as a financial historian, I always bet on the state winning because they shoot people. They usually win. And everybody that I know in Wall Street tells me that Wall Street always wins, so we're going to find out sooner or later.
Questions?
Is this working? Yes. Given your comments about the Shiller PE in the US, and given the size of US market capitalization in global stock indices, what is your view about global equity markets, given that view on the US market, which is such a dominant share of the global market?
Yeah, so I'll go to my first slide, which was the one about supply and China. So if you look at the world, there are lots of companies who have been virtually destroyed by Chinese competition. Many of them actually have been destroyed by Chinese competition. Some of them survived. If we woke up one morning and there was no Chinese competition, they would do exceptionally well. And they are part of Canada's industrial policy. They are part of France's industrial policy, Germany, everyone's got an industrial policy. And these are the very companies that are going to be invested in and looked after, because this is going to make us independent of China. Fascinating, when Mark Carney announced the pension fund change last week, he didn't say it was to make Canada independent of China. He said it was to make Canada independent of America. Now, if that's true, just imagine the scale of the investment boom that would have to take place. So the world is littered with equities that will benefit from that. That's the good news. The bad news is they're about 3% of global market capitalization. So it's easy for me to sit here and say, oh, don't buy the stock market. But I've got a lot of money in stocks. It's just not in the stock market. It's in all these companies that have been decimated by Chinese competition. So the outlook is not good for the stock market. Simple equation. If the Germans and the French and the British all demand that their savings institutions buy government bonds, what are they all going to sell? The stock market is what they're going to sell. So you can't, it's hard to get to a world of financial repression where I'm making you all buy bonds and you're not selling the stock market. So don't buy the stock market, buy these really attractive companies, or find an investment manager who's capable of selecting those. So the good news for the professionals in the audience is active management will be back and passive management will be over. And if I say that long enough, one year it will actually be true. And that's why you need to study financial history, because you're going to have a whole new skill set, a whole new different type of companies. So if you live in a world of higher inflation and low interest rates, actually you'd want to own equities. The problem is that everybody will be selling them to buy bonds. So I think it'll be really interesting when the pension funds bring their money back to Canada to see what they actually invest in. But I think the plan is absolutely for them to fund capital expenditure and investment and all the stuff that is currently made in China. And if you're making that stuff and selling that stuff, you're going to make a lot of money.
One more question from the audience, and I want to ask the final question. Anyone in the audience have a final question? Yeah.
What would you buy right now?
Can we just take a mic? It's quite hard to hear otherwise. Sorry.
You there? So, having said that, I think you said the table, what would you buy right now? You said like these companies, or can you make examples of some sectors?
Sure, yeah. Shipbuilding, steel, chemicals, medical devices. There is an easier way to do this. You look at Canada or America, and you look at every industry that has been dominated by China, where China has been the price setter, where everybody else has been a price taker, and you buy those industries. I've mentioned 3 or 4. But actually you'll find quite a lot of them, but it needs a lot of research. It's quite exciting to go out and find those companies, but there are 4 or 5 you can run off pretty quickly, but there'll be lots more of them. And quite a lot of them are in Canada. Of course they are. So I think I'm a bit old for this now, but it's a very exciting time, I think, to be a young stock picker roaming across North America, looking for all the beneficiaries of this, because nobody else will be doing it. You might be out there on your own, and that's particularly exciting.
I'm going to take the advantage of being the person up here asking the questions to ask the final one, which is you've suggested that what may happen over the next 5 to 10 years is going to be quite different to what's happened in the last 30 years. Maybe we have more inflation, quite likely we get financial repression, we're getting a whole new monetary system. So my question would be, if we're recommending people here to study one period in history that will give them some lessons to what we might live through in the next 5 to 10 years. Which period and what books and what things would you study to do that?
So financial repression is really something really invented only during the warfare, but there is one period where it wasn't used in warfare, and that's the period you have to study. So that's the period after World War II. So we obviously ended World War II with excessive amounts of debt, and that debt by 1982 has all been, debt to GDP has been brought down. It's been brought down by financial repression, so we need to look at that. And that was, obviously Canada had a huge amounts of debt as well because of its efforts during World War II. So you've got to read about that. It's actually very badly covered. The reason it's very...
My next question was what book to read?
Well, there are books, but it's really badly covered because it's not dramatic. Stealing money from old people slowly isn't a great spectator sport.
That sounds like the title of your next book then.
Well, actually, funnily enough, I did say that in the last book, but I've been too busy to write it. No one's going to make a movie called Stealing Money from Old People Slowly. But you can't write a movie, make a movie about the great crash in 1929, you see. So anyway, there are books. I'll say we're not being recorded, are we? So we, like Mistakes, we're going to get into the publishing business. And we're going to do a subscription series. So you pay me, let's say 100 Canadian, and you get 2 books a year. And one of the books is that book. So this book, and it's very hard to get at the minute, that's why we're going to reprint it. It's called The Stock Market, 50 Years of Capitalism at Work by John Littlewood. And it covers the UK stock market in that period. And it covers it year by year. So you see how the whole system works in this kind of world where the government's bigger, financial repression, inflation. For one stark example, rent controls. I know you have rent controls in parts of Canada. Rent controls were brought in not necessarily to protect tenants, but to make property less attractive relative to bonds as an investment. It's kind of simple stuff like that. We had a capital committee, and the capital committee said who had permission to issue bonds and equities. And only if your equity issuance was to further the public good would you get to issue that piece of paper. So that's all embedded in that work. David Kinniston has written a huge 4-volume history of the City of London, and the last volume covers that period post-World War II. Sadly, I don't know the Canadian examples, but the brilliant thing about having a Library of Mistakes Montreal is you're going to build that collection. And the next time I'm going to be asking you the question, and you're going to show me how that, what I should be reading about Canada in the post-World War II period. So that's the period to study. And I would just say this, when the government is getting involved in that, it creates what some people call arbitrage opportunities and other people call smuggling. So arbitrage opportunities, we'll stick with that, but being one step ahead of the government is what markets have always done. And then the government goes around, and it's like a giant game of whack-a-mole, which is what I've learned from reading the history of this period. And so I would go for those 2 books. They both happen to be about British financial history, but Britain was pretty aggressive on the financial repression. So one final thing, we had 2 parties in Britain at this stage, Labour Party, Conservative, left wing, right wing. One of the Chancellors of the Exchequer was called Rob Butler, one of them was called Hugh Gateskill, but the period was known as Butskillism, because it didn't matter who you voted for, you got exactly the same thing. Because the political imperative du jour is inflate away these debts. And it doesn't matter who you vote for, that's what you're going to get. So that's stealing money from old people slowly. And let's hope it's only slowly.
Well, we could discuss all night, I'm sure, but we're running out of time. Just want you to join me in thanking Russell for a brilliant insight.
Merci beaucoup, Russell. J'ai beaucoup apprécié le commentaire sur le rent control comme outil de répression financière pour rendre les obligations plus attrayantes. On apprend toujours quelque chose lorsqu'on vous écoute. C'est grandement apprécié. Alors, je me présente. Mon nom est Carl Bouvin. Je suis le directeur général de l'Observatoire des erreurs. Je suis aussi membre du conseil d'administration. Et l'Observatoire des erreurs, c'est un projet qui trotte dans ma tête, ainsi que dans celle de François Boutin-Dufresne depuis plusieurs années. D'ailleurs, une anecdote intéressante, parce que François squattait les bureaux du boulevard Saint-Laurent en 2018 et il parlait de son club de lecture glorifié. Donc, c'est quelque chose sur lequel on a cogité. Et au début de l'année, lorsque j'étais en Floride, François m'a contacté et a relancé l'idée. Alors, ça s'est matérialisé suite à une discussion qu'on a eue avec David Clark et Russell Napier, Erreurs de Montréal. Donc, l'Observatoire des erreurs, c'est un projet d'éducation populaire. Comme on le mentionnait au début, ça va être beaucoup plus qu'un lieu d'archivage de documents et de livres. Ça va être aussi un endroit où on va faire régulièrement des conférences comme celle-ci. On prévoit en 2026 en faire probablement 6 et les années subséquentes probablement 12 si on atteint notre vitesse de croisière, bien entendu. Donc, L'Observatoire des erreurs ce soir, c'est un peu un lancement virtuel. Donc, l'organisation est up and running depuis à peu près 1 mois et demi. On a un OBNL qui est enregistré, un conseil d'administration. Et à l'heure actuelle, on travaille essentiellement sur le financement. Donc, à cet égard, j'aimerais remercier encore une fois nos 2 premiers sponsors, donc le CAP et BCA, pour leur donation qui nous permettent de partir nos activités. Alors, à l'heure actuelle, on travaille très fort sur l'élaboration du programme des conférences pour 2026. Et aussi, on est à la recherche d'un local, donc on a eu des discussions récemment avec plusieurs partenaires pour qu'on puisse avoir une pignon sur rue et qu'on puisse, bien entendu, y déposer 4000 ouvrages. Donc, ça va demander du financement pour qu'on puisse acquérir ces livres-là. Donc, au nom du conseil d'administration et du CA, je tiens à vous remercier ce soir de votre présence. C'est grandement apprécié. Comme je le disais, c'est un projet d'éducation populaire. On vise d'élargir l'audience au-delà du traditionnel cercle des gens de l'industrie des services financiers de Montréal. Donc, ce soir, bien entendu, on a lancé une invitation dans notre réseau. Donc, on a beaucoup de représentants de l'industrie des services financiers. Mais si vous avez apprécié, si vous aimez le concept, je vous invite à en parler à vos jeunes, à vos enfants, à tout le monde au milieu, afin qu'on puisse étendre l'audience et qu'on puisse mener à bien une mission d'éducation populaire qui est l'enseignement de l'histoire de l'économie. Donc, sur ce, je vous invite à rester quelques minutes de plus avec nous. Et il y a de l'alcool, du vin et un peu de nourriture. Donc voilà. Merci beaucoup.